All right, in today's video, I'm going to be going over which asset class you should buy based on your situation. It's probably one of the most common questions I get asked. Hey, Matthew, I have some money or I'm going to be raising some money here, and I want to know which type of property to buy. And really, it depends on your situation. The answer differs wildly. For those of you who don't know who I am, my name is Matthew. I go by Commercial Deal Junkie. I'm a commercial broker and investor based out of Southern California. And me and my investment firm, we buy commercial property all over the country. All right, so let's go over the different asset classes and which one's best for which. So I really break it down into a matrix on passive, active, and which type of assets have what type of returns. Okay, so let's start here. Passive but has low returns. That's your classic single tenant net lease. That is your Starbucks, your CVS's, your medical buildings, single tenant medical buildings, single tenant industrial. These will typically pay anywhere from a 4.5 to a 7.5 cap, maybe an 8% cap rate. And the safer the investment is, the lower the returns will be. For example, if you have a Starbucks on a 20-year lease that'll sell at a 5 cap versus a Starbucks that only has 5 years left, might sell at a 7 or an 8 cap. A CVS, for example, if they have a long time left, if the industrial tenant has a lot of, if they're high credit worthy, it'll tend to have lower returns. So the safer it is, the more passive it is, the lower the returns are. Okay. Then you have active with low returns. And if you know me, you know I'm not a fan of hotels. I personally never bought one, but from the people in the industry I know that are in the hotel business, the returns are actually a lot lower than people think because even though it might look like an 8 cap or a 9 cap, the capital expenditures tend to be quite high. Every couple of years, you have to do what's called a PIP, property improvement plan that the brand will require. And the people that are doing really well in hotels tend to run it more on a mom and pop. Now, on a massive scale, can you make good turns returns with hotels by taking, non-branded hotels and making them branded? You can, but in most cases, hotels are pretty active and don't have the strongest returns, in my opinion, when it comes to looking at net free cash flow, not just above the line cap rate. All right, passive and high returns. Now, if you're looking for something passive and high returns, you're in fairy tale land. It really doesn't exist. Maybe you can partner with someone that handles the deal. In some situations, you can invest with someone that will chase higher return deals. But in reality, it's nearly impossible to find a property that's going to be super passive and give you a 10, 12, 15% cap rate. If that's what you're looking for, you're just asking for a world of trouble because that is the easiest way to lose your shirt is to look for a passive deal with high returns. Now, lastly, and this is the box I live in personally, is active with high returns. These properties tend to be multi-tenant retail, apartment buildings, office buildings, believe it or not. Office buildings, there is opportunity in the office space, contrary to what you hear all over the news. And then other things like multi-tenant industrial, self-storage, mobile home parks. Those are all examples of active investments that offer high returns. So first these are the two major quadrants, passive and low returns and active and high return. And you got to kind of figure out which one of these you want to be in. Now, obviously, like, oh, I want high returns, I should go with the active one, but it really depends on who you are. And that goes into this next slide here. This next slide here is about who fits what bucket. Okay, so first we have the active and high returns. This is typically for, younger professionals, maybe that are already in the field, maybe they're brokers, loan officers, maybe they just sold a business for an exit and now they have a lot of time. So these are people that have the time to hop on the phone, which is why I chose this photo, have the time to hop on the phone and manage the apartment building or manage the property management company. Just because you get a property management company, I don't want you to think these are going to be hands off. You're still going to be hands on with turnover, making sure the property management team isn't blowing all your money. So even if you do have a property management team, you still have to handhold. And you can juice these even further by making them value add deals. So if you buy a apartment building, let's say with a lot of vacancy or really low rents, you can stabilize it and make really great returns. But the problem is that takes time. It takes time, takes energy, it takes knowledge. So there's work involved, but that's really how you achieve that 20, 30% returns annualized is by buying these value add deals that take a lot of time and effort and leasing and keeping the expenses under control and doing repairs. And this is the world I live in. because my full-time job is to purchase and stabilize investment property. So I buy stuff like strip centers that are falling apart, I clean them up, lease them up. I buy apartment buildings, less so much now, but for the first part of my career, as in a fund manager, I bought apartment buildings that were falling apart and had vacancy, cleaned them up, filled them up. And that's how I'm able to achieve 20, 30% IRRs in my portfolio. It's because I'm an active and knowledgeable real estate investor. Now, that doesn't work for everyone. On the other hand, you have other people, like older people that are already retired and don't have the time or energy or maybe knowledge to manage these assets, or super busy working professionals. Like I have a lot of people come to me that are working 60 hours a week in the tech space, or physicians that are working long hours, or business owners that are just looking to diversify their income and maybe get some of the tax benefits of real estate. For those people, I highly encourage them to go towards the single tenant net lease space, where you're going to get a 5 or 6% cap rate on a CVS, a Starbucks, a medical building, a single tenant industrial building. And, but they'll likely have 10, 15, 20 years left on the lease. They're responsible for all the repairs and maintenance and everything about it. They send you money every month. That's all it is. You give them an account number and a routing number, and then they deposit money, or they mail you a check every month. And you still get the tax benefits, you get to diversify your income, but don't expect any crazy returns. Like I said, they're typically between 4.5 to 7.5%. So again, if you're older and you really don't want to you just want to be able to rest and use your money to bring you returns without spending a whole bunch of time, or you're a really busy professional, these are probably the best options for you. So that's really the major types of real estate. It really comes down to, do you have the capacity, the knowledge, or the willingness to learn? And are you willing to be really involved in your real estate? If that's the case, I highly encourage you to look for multi-tenant retail, in multi-tenant industrial, apartment buildings, or if you're really ballsy and you're willing to learn the game, office. Believe it or not, a lot of people push back to me on this office thing. But for example, I know someone that purchased an office building that was 25% occupied. So it was mostly vacant, but he was getting an 8 cap on the actual occupancy to 25%. So all he did is he filled up the rest of the building at really low rents. Everyone else in the market was asking $28 a square foot in rent, and he rented it out at 15. So he rented it out significantly below market, almost half below market, filled out the rest of the building, and then he was making over a 20 cap on his entry. So there are still places to be in office simply because of how distressed it is. But again, it's a very active type of investment. And then some people, in many cases, people end up in this box, um, you know, where they're looking for something passive, something they don't have to worry about, and they can just collect checks. And then on the other end, if you're looking for passive with high returns, even though for the most part that's a fairy tale, that's when you may be in a situation where you want to partner with an investor, or someone that is active, that's gonna where they're operating in this active high return space, and then you can take a percentage of the deal and make a portion of these returns active and high returns. So if you do want to be passive and you want higher returns than the single tenant net lease space, you want someone that's operating in the active high return space, partner with them, be a capital investor, an equity investor in their deals in order to build something, which is a lot of our investors. I mean, our investors, enjoy 20, 30% returns, and they're completely passive because we play in this field. So we're able to give them those returns, and then we charge a fee to do so because we're operating in this field. So we take our capital, we join it with investor capital, and then we buy value add retail, value add industrial, apartment buildings, etc. So I hope that helps you decide if you're looking on what type of asset class to buy and where you're going to end up exactly on this matrix. But go out there and start making offers, start looking for deals, learn to run the numbers. Even the single tenant net lease space, there's still things you need to know about it. You can't just go out and buy any building with a cap rate. And I'll actually put the link to the video where I go over how to choose single tenant net lease buildings, because they're not all created equal. It's not just the cap rate and how many years are left on the term. There's more things to consider in here. But anyway, I hope you guys enjoyed the video and are now able to better narrow down the type of asset class that you should invest in. Like, subscribe, do all that stuff, and I'll catch you guys on the next video.